Welcome back to the deep dive. Today, we're taking a close look at Uber Technologies. That's UBER on the ticker. We've got a stack of reports here, financials, market analyses, you name it. We've really tried to sift through it all. Our aim is to give you a clear picture of where Uber is now and, well, where it might be heading.
Yeah, exactly. Our mission today is really to unpack how Uber, which, everyone remembers as being all about just growth, 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 how they've actually managed this switch to, well, making money,
Yeah.
profitability, and also how they're playing this whole autonomous vehicle game, which is heating up. What are the big opportunities? What are the roadblocks ahead? Think of this as your shortcut, really, to understanding this huge company shaping mobility and delivery.
Okay, let's start with that financial turnaround, because it is remarkable. For years, Uber was just burning cash, right? The whole growth at all costs thing. But that seems over now.
Oh, absolutely. The data makes that really clear. It's a fundamental change in strategy. They pivoted quite strongly, actually, towards sustained profitability, generating solid cash flow. It's not just about trimming the fat. They're running a much tighter ship, a more efficient operation. And what's really interesting is how this changes things for them competitively and how investors see them now.
And the numbers, they really do tell that story. I mean, growth is there, definitely. But what really jumps out is the underlying strength when you strip out currency swings. So Q1 2025, gross bookings up 14% year over year, $42.8 billion. But that's actually 18% if exchange rates hadn't changed, right? Constant currency. Revenue, similar story, up 14% to $11.5 billion, or 17% in constant currency.
Yeah, and the net income swing is, well, it's pretty stark. They went from losing, what was it, $654 million in Q1 24 to making $1.8 billion in Q1 25. That's quite a turnaround. And their adjusted EBITDA, that's, a measure of core operational profit, before all the accounting stuff like interest and taxes that grew a solid 35% year over year, hit $1.9 billion. Gives a clearer view of the actual business health.
Right. And zooming out, the full year 2024 picture, it looks even stronger. Gross bookings up 18%, $162.77 billion for the year. And that official net income number, $9.85 billion. Now, okay, you have to dig a bit deeper there. There was a big $6.4 billion tax benefit, another $1.8 billion from equity stuff. But even taking those into account, the core business, the operational improvements, they're definitely there. And free cash flow, the actual cash they generated after running the business and investing, that hit $6.89 billion. That's more than double 2023, 105% increase.
Huge. And this profitability, it's not just happening by magic. It's down to real operational efficiency gains. You mentioned adjusted EBITDA earlier. Well, the margin improved. It went from 3.7% in Q1 24 to 4.4% in Q1 25. And that's linked directly to a few things. They're getting more leverage from higher volumes, basically economies of scale kicking in, plus more advertising revenue, especially in the delivery side. And critically, they're using AI quite strategically. Optimizing routes, balancing drivers and riders, that sort of thing. AI isn't just a buzzword for them. It's, it's actually driving efficiency and boosting profits. It lets them out-invest smaller rivals in key tech.
Okay, so the numbers are impressive, but let's talk about the platform itself. It's way more than just rides now.
Oh, absolutely. It's really three core parts now. You've got mobility, the original ride-hailing service. That's still foundational. Then there's delivery. That's mainly Uber Eats, but it's expanded hugely. Groceries, pharmacy, convenience items. They've even got new partnerships like DICKS Sporting Goods and Golf Galaxy. It's delivering sporting goods.
Really?
And third, freight. That's their logistics arm for businesses.
And the scale is just, wow, over 70 countries, 10,000 cities. That kind of scale must create incredibly powerful network effects, right? More users attract more drivers, attract more restaurants and stores. It feeds itself. But does that scale also mean they face, unique regulatory headaches or labor issues that smaller players maybe dodge? Is it a bit of a double-edged sword?
That's a really good point. It is complex. I mean, yeah, they're the leader in ride-hailing against Lyft, Bolt, Didi, others, and in delivery against regional players like iFood in Brazil. But that size absolutely brings more scrutiny. Regulators watch them closely, labor groups focus on them. Still, they seem to be using partnerships strategically, like that iFood deal in Brazil, to sort of navigate those challenges and even strengthen their position rather than just trying to avoid the heat.
Now, this Uber AI solutions thing you mentioned briefly that really stood out to me. Usually AI is an internal tool, but they're actually offering their AI data platform to other companies. Who would even buy that? And how big could this actually become for them? Is it a serious revenue stream or more strategic?
It's likely more strategic, at least for now, but it's a fascinating move. What it suggests, I think, is that Uber is betting that human-in-the-loop AI training, basically, Using real-world data and human feedback to constantly improve AI will stay crucial for complex stuff. And they have this massive unique data set from their operations that pure AI companies might not have. So think about who needs that.
Mhm.
Logistics firms, maybe mapping companies, other mobility startups, people who need highly curated real-world data but don't want to build that capability from scratch. It positions Uber not just as a ride company, but potentially as like an infrastructure player for the broader AI world.
Okay, so leveraging AI internally for efficiency, even selling that expertise externally. Does that AI capability then directly feed into their strategy for, well, the elephant in the room?
Yeah.
Robotaxes. How does that internal AI work connect to this huge potential market?
It's the perfect connection, actually, because all that operational data, all that AI optimization work, it gives them deep insights into the messy, complex, real-world conditions that autonomous vehicles have to navigate.
Yeah.
And the market projections for robotaxis, they're just mind-boggling. We're talking the global autonomous vehicle market possibly surging from, what, $1.5 trillion in 2022
Mhm.
to maybe $13.6 trillion by 2030. That's a CIGR of over 32%.
Wow.
And ARK Invest, they're even more bullish on the service side, autonomous mobility as a service, or MaaS. They see that exceeding $10 trillion in sales by the early 2030s.
Trillion.
Yeah, and China specifically. They
Hmm.
expect the robotaxi market there to go from maybe $54 million in 2025 to $47 billion by 2035. That's like 757 times bigger.
That's just explosive growth. What's actually driving forecasts like that?
Well, it's a few key things. Technology is getting better, obviously, especially level 4 autonomy. It's maturing. Then there's the cost. This is huge. Robotaxis could potentially drop the cost per mile way down, maybe from over $1 for your own car to something like 25 cents.
25 cents a mile.
Yeah, potentially. That makes it incredibly compelling economically. Hardware costs for sensors and computers are also falling. Plus, you're seeing more supportive policies popping up. Safety is improving. Waymo talks about 92% fewer pedestrian injuries in their data. And there's the promise of just making cities work better. Less congestion, maybe fewer emissions. I mean, think about it. If your commute genuinely costs less than your morning coffee, like you said, 25 cents a mile, that changes everything for millions of people, doesn't it?
That's a great way to frame it. Yeah, game changing. But it's not going to be simple, right? There must be some major hurdles.
Oh, absolutely. It's not a straight line. You've
Mm-mm.
got inconsistent regulations, different rules in different states, different countries.
Yeah.
It's a patchwork nightmare
Yeah.
for companies trying to deploy this stuff. Public trust is another big one. People are still wary, especially after high-profile incidents like the one involving Cruise a while back.
Yeah.
That really hurt public perception.
Right.
And then there's just the sheer cost. R&D is incredibly expensive. Deploying and running these fleets costs a fortune, and you need the right infrastructure in place too.
Okay, before we get into the players, maybe quickly break down these levels of autonomy for us, especially level 2 versus level 4. We hear those terms thrown around a lot.
Sure. So the SAE Society of Automotive Engineers, they have these levels, 0 to 5. Level 2, think Tesla's autopilot or FSD beta. The car can help with steering, speed, staying in lane, but crucially, the human driver must always be paying attention, hands on the wheel, ready to take over instantly. It's driver assistance. Level 4 is a big jump. This is what Waymo, Baidu, Pony.ai, WeRide, Zoox are aiming for. The car can handle all driving tasks itself, but only within a specific defined area and conditions, what they call the operational design domain, or ODD. Within that ODD, the car can handle emergencies, pull over safely if needed. No human intervention is generally required within those specific conditions. It's true self-driving, but geographically or situationally limited.
Got it. That's a really key distinction. So who are the main contenders in this AV space, and how do their approaches differ?
While Waymo, which came out of Google, is definitely a leader, they've had driverless services running since 2020 in places like Phoenix. They use a full sensor, suite cameras, radar, and importantly, LiDAR. Then you have Tesla taking a very different path. Elon Musk is betting big on cameras alone, a vision-only system. Their FSD beta is level 2, but they're pushing towards robotaxis, aiming for a launch in Austin. Right, the vision-only bet. Contentious, very. Then there's Cruise, owned by GM. They were operating in San Francisco but had that major setback and had to suspend operations for a while. They're trying to restart cautiously. In China, you've got some really strong players, Baidu with Apollo, Pony.ai. WeRide, interestingly, Uber is actually an investor in WeRide.
Oh, okay.
And you've also got Zoox, which is backed by Amazon.
Huh?
They're developing a purpose-built vehicle designed from the ground up to be autonomous, no steering wheel or pedals.
Oh.
So yeah, different players, different strategies, especially that Tesla vision only versus the multi-sensor approach used by most others.
Okay, and this is where Uber's strategy gets really interesting, like you said. They specifically chose not to build their own level 4 or 5 self-driving tech in-house. They sold off their unit doing that research. What's the thinking there? What are the pros and maybe the cons of that decision?
It's fundamentally a de-risking strategy, and arguably a very smart one given the sheer cost and complexity. Developing level 45 autonomy requires astronomical investment in R&D, it's fraught with technical challenges, and the regulatory path is, well, uncertain, to say the least. By partnering instead with Waymo in Phoenix, with May Mobility, with Wave in the UK and Europe, Momenta in Asia, and they had earlier ties with WeRide and Pony.ai too, Uber basically sidesteps all that direct capital expenditure and R&D headache.
So they let others spend the billions developing the core tech.
Okay.
And Uber focuses on what they do best, the platform, the user base, the operations, the demand generation.
Precisely. They leveraged their existing dominance in ride-hailing and delivery, their huge customer base, their sophisticated dispatching and matching algorithms, and they integrate the AV technology from partners once it's proven and ready to scale.
It's kind of like Uber wants to be the operating system for autonomous mobility, regardless of who makes the hardware or the core driving software, like a high-tech transport broker. But does this mean they might miss out on the highest margin part of the business owning the actual self-driving software stack? Or is playing the aggregator role the smarter long-term play for market share?
That's the multi-trillion-dollar question, isn't it? It's the core trade-off. Their approach definitely lets them scale faster and reach more markets once AV tech matures and regulations allow it, because they aren't tied to one specific tech development cycle. It lowers their risk profile significantly. But yes, the flip side is they won't capture the potentially massive value generated by owning the core autonomous driving system itself. They'll be paying partners for access to that tech. It's a calculated bet that controlling the customer relationship and the network is where the sustainable advantage lies, even if they don't own every piece of the underlying technology.
Makes sense. Okay, so we've talked tech financials, but Uber operates in the real world. We can't ignore things like public perception, the regulatory maze, and those ongoing labor and legal fights. These aren't just side issues, are they? How do they sort of interact with Uber's big plans for profitability and AVs? Do they constrain them?
They absolutely interact, and they definitely can constrain them. You can't separate the tech from the social and legal context. Take public acceptance of AVs. It varies hugely. Some cities, especially in China, seem quite eager. But in the US, UK, Australia, surveys show more caution, more concerns about safety and trust, and a single high-profile accident, like the cruise incident, can really set back public trust and trigger tighter regulations across the board.
Right, so a setback for one AV company can ripple out and affect Uber's partnership plans, even if their partners weren't involved.
Exactly. And you could even see, say, a major AV incident reigniting debates about labor rules. Maybe calls for mandatory human safety operators for longer, which increases costs and slows down the robotaxi vision. It's all interconnected.
And the safety records themselves show real differences. Waymo's data suggests their AVs are significantly safer than human drivers over millions of miles. But Tesla's FSD has faced scrutiny over incidents and investigations. And even the leaders aren't perfect. We saw Waymo and Zeus do voluntary software recalls recently. It shows safety is an ongoing process, not a solved problem.
Definitely. And the regulatory environment is just messy. There's no consistent national framework for AVs in the U.S., for instance. It's state by state. California's cautious. Texas has been more open, but is adding rules too. Companies have to navigate this complex, shifting patchwork. And fundamental questions like who is legally liable when an AV crashes are still being worked out. It's a huge challenge. It really highlights that even a giant tech company like Uber is subject to these ground-level realities. It's not just about cool tech. It's about laws people trust.
And then you layer on the specific labor and legal challenges Uber faces directly. These seem like significant material risks. We've got New York City setting minimum pay for drivers. That Oxford study suggesting driver earnings have dropped since 2023 because of dynamic pricing and Uber's higher take rate.
Right. And there's that big lawsuit in California over driver classification. Are they employees or contractors? That's potentially huge. Trial maybe in 2026. Plus concerns about proposed rules in Hong Kong capping driver numbers. These things directly hit driver availability, driver earnings, and potentially Uber's costs and profitability. And on the legal front, separate from labor, there's that large consolidated lawsuit, the MDL, involving over 1,400 sexual assault claims. The first trial is scheduled for December 2025. That's a very serious issue with potentially significant reputational and financial implications.
And the FTC lawsuit, too, about making it hard to cancel Uber One subscriptions.
Yeah, that adds to the regulatory pressure.
So all these challenges, they demand constant attention from Uber's management, don't they? Maintaining stability, public image, driver relations, it's all tied to their bottom line. It sounds like a relentless balancing act.
It absolutely is. They're juggling innovation, growth, profitability, and all these complex societal, legal, and labor dynamics. It's not easy.
Okay, let's switch gears finally to the market's view. How is Wall Street judging all this? Let's look at it, the technicals, the sentiment. As of late June 2025, UBR is trading around, what, $83, $84, near the top end of its 52-week range, which went from about $55 up to $93, $94. And the performance history is pretty strong lately, up over 35% in 6 months, nearly 19% in the past year, and over 260% over 3 years. That's impressive momentum.
Yeah, the long-term trend is definitely positive. Looking at the charts, though, it's a bit mixed right now. The current price has actually dipped below its 20-day moving average, which often suggests some short-term weakness or maybe just consolidation after the run-up. But importantly, it's still comfortably above the longer-term 50-day and 200-day moving averages, and those are trending upwards. That confirms the underlying positive long-term trend is intact.
Wow.
Other indicators, like the RSI, are pretty neutral. Volatility is moderate.
So, okay, you've got the stock near its highs, but maybe some signs of needing a breather in the very short term. What does that discrepancy tell us? It feels like the market is saying, maybe a bit choppy day to day, but we believe in the bigger story, right?
I think that's a fair reading. It suggests investors are looking past any immediate technical noise and pricing in future growth. They're likely focused on that sustained profitability story we talked about and the massive potential upside from autonomous vehicles, even if it's still years away. They seem willing to hold on, anticipating positive developments rather than getting spooked by short-term chart patterns.
And the analysts seem to agree overwhelmingly. The consensus is strong buy, something like 92% of analysts covering the stock rate up buy. Only about 7% say hold, virtually no sells. And the price targets suggest decent upside. The average target is around $98, median maybe $85 $86, but some go as high as $115.
Yeah, that's strong conviction. And you see it reflected in the institutional ownership, too. Big players like Vanguard hold significant stakes, nearly 9%. It is interesting, though, to contrast this with someone like Kathy Wood at ARK Invest. Her focus is heavily on Tesla's robotaxi potential. She's incredibly bullish there, suggesting robotaxis could be like 90% of Tesla's value by 2029, justifying a price target way up at $2,600.
Wow, okay. That's a very different view.
It really highlights how differently people are valuing this nascent AV market. Mainstream analysts seem more grounded on Uber's current profitability and partnership model, while ARK is making a huge concentrated bet on Tesla cracking the code with their specific approach. Different assumptions, different valuations.
So it really comes down to which vision you buy into for the future of autonomous mobility. Uber's partnership aggregator model or Tesla's vertically integrated all-in approach, a key thing for investors to chew on.
Definitely. Uber's path seems lower risk in terms of R&D spend, but maybe offers less of the spectacular upside if Tesla does pull off its vision. It's a fascinating contrast.
Okay, so let's try and wrap this up for you. What have we learned from this deep dive? We've seen Uber make this really significant shift, moving away from just chasing growth to focusing hard on profitability and efficiency. And it's working, based on the numbers. Their strategy for autonomous vehicles is unique partnering rather than building it all themselves. It positions them to grab a piece of potentially enormous market, but without taking on all the massive R&D risk directly.
Yeah, and we've seen that analysts are largely confident in this story. Strong buy ratings, positive price targets, but, and it's a big but, there are these persistent headwinds, the complex regulations, the ongoing labor issues, the legal challenges. These require constant, careful management. They're not just background noise. They can directly impact operations and profitability.
What really strikes me is how Uber seems to be positioning itself as this ultimate connector, connecting riders and drivers, connecting diners and restaurants, freight shippers and carriers, and now connecting advanced AV technology wherever it comes from with its huge existing platform and user base. It's a picture of a company that's not just surviving, but actively trying to evolve and adapt in a really fast-changing world.
So here's something to think about as we finish up. We talked about robotaxis potentially slashing the cost per mile, reshaping cities. But beyond just making rides and deliveries cheaper or more efficient, how might widespread autonomous mobility really change things? Could it fundamentally alter how we think about owning cars, how our neighborhoods are designed, and what totally new services, things we can't even properly imagine today, might become possible when you have this hyper-efficient, AI-driven mobility platform running things? That's something to ponder.